Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And over the weekend, we obviously had some news with regards to US getting involved in the Iran um, conflict in the Middle East. It seems like we opened up on Monday with some concerns about if there was potential fallout and kind of a wider regional conflict in the Middle East that was going to potentially have longer lasting impact on kind of assets as well as crude specifically. But I think it was very clear by the end of yesterday and more so as of today that those concerns have largely eased. Crude opened up on Monday at 78. We're now closed at around 65, basically levels that we saw before Israel started to bomb Iran. Equity markets rallied higher here. The technology XLK substantially higher here at the open above the 52-week highs. So we really have turned around quite significantly from kind of a more risk adverse tone that we saw here going into the weekend versus what we're seeing here as of this week. I think we are, pretty close to making a crack at the recent all-time highs on the S&P 500. We've been consolidating after the past month or so, after what has been one of the strongest rallies we've seen on the S&P 500. This 25% rally on the S&P 500 is one of the fastest we've seen in history. So typically after big rallies like this, you typically get a period of consolidation. That's largely what we've seen over the last month. And it looks like we're starting to see further upside here for equities. So overall, we're really seeing, continuation of bullish signals here going into this morning's open. You see, if you look at the the Nasdaq 100, the Qs, we see that on the Qs, we see a similar type price action, where we basically have consolidated after a period of outperformance here. Now, as you can see, the Qs are very close to the all-time highs after what is one of the more spectacular rallies we've seen out of tech, sideways consolidation, and now it looks like we're ready to start pushing higher here in tech. If you look at small caps, we've seen small caps also break out here as well. You see small caps kind of recently breaking out above this 210 level. This is a level that has been support and resistance for quite some time. So far, we look like we're about to push higher here above that, heading into the 230 range here for IWM. And then lastly, RSP, the equal weight S&P 500 index. This is the one index that has been lagging behind, that is starting to show some strength here. Hasn't quite broken out here above this 180 level here just yet. And that's kind of the last level we're paying attention to here right now for that potential upside for RSP, the equal weight S&P 500 index. So we really have seen, a relatively calm market here. We saw the VIX also pull back here. It's now below around 18 level here on the VIX. We very much have a environment where it seems to be favorable to be short volatility, long equities going into this particular week. If you look at bonds, HYG recently made a new 52-week high. So bond markets also providing kind of a risk-on signal here. As you can see, bond markets continue to power higher here with little signs of exhaustion. TLT, the bond ETF, also starting to see a little bit of a rally here, which is as we continue to grind higher off these lows. As you can see, that trend quality has started to improve here. We've had 4 days of relatively, improving trends that we're looking for a potential continuation higher here. That would convert to lower yields on the 10-year yield, and potential further upside and further support here for equities. So, overall, we're heading into an environment that seems quite favorable here for overall equities, and some of the bullish ideas that we have here for the week. Now let's take a look at some of our trade opportunities. Sorry, I accidentally closed out the options wizard. So the first trade opportunity I want to take a look at here is Norfolk Southern. Railroad stocks is not something that we usually pay much attention to here. But recently, some of these railroad stocks have really started to outperform here. The breakout here above 225 has been significant. We've seen continue to outperform it since we saw that breakout here. And now we're testing this 255 level here onto our 275 upside target here for Norfolk Southern. Now, Norfolk Summer trades at about 20 times forward earnings, which is relatively inexpensive. I'm sorry, relatively on par with the rest of the railroad stocks. However, if you look at kind of growth expectations, most railroad stocks are expected to grow somewhere in that 10 to, bottom line around 10%, top line around 4 or 5%. And Norfolk Southern is right there alongside with the averages for the industry. But where Norfolk Southern really outperforms is the fact that it has net margins north of 27%. The average railroad stock, transportation stock, net margins are around 5, 6%. So, that's really kind of where, if you look at some of the opportunities within railroads, Norfolk Southern really kind of stands out as a potential opportunity here. So for those reasons, I really like seeing some of these railroad stocks outperform here in this type of market environment because the economic indicators that we continue to see out of the U.S. remain quite resilient, and for those reasons, some of these railroad stocks are really doing quite well. Another one I want to take a look at here is Alphabet. Alphabet recently pulled back quite a bit here, and I think actually that pullback presents a buying opportunity. It actually generated a buy signal here on our options play platform here. Basically, we see this uptrend, we pull back to the trend line here, and I think that's an opportunity where the risk to reward looks quite favorable here to the upside. Alphabet trades at only 17 times forward earnings, so it is very inexpensive relative to the technology group, specifically within the AI theme. It's expected to grow just in line with the rest of the industry, but where it excels is, its profitability, 30% net margins, so far superior net margins relative to the industry. So for those reasons, the fact that it trades at a discount to the industry is really what presents that upside opportunity here. I think you can either look at selling some premium here by choosing maybe selling a put vertical here, or even looking at buying some upside here. That 165, 185 call spread looks quite attractive where you're getting a more than a 2-to-1 risk to reward ratio on a trade like that for Alphabet. Another one that I want to take a look at here is Target. Target has really been a strong underperformer here for quite some time. Whoops, wrong chart. Target has been an underperformer here for quite some time. And the question is whether or not that underperformance is starting to end, right? So look at this longer term chart here. This was a $175 stock that's, traded all the way down to 87. So we, more than 50% decline in the underlying stock. And over the last, call it, couple of months, as you can see, that trend quality has started to improve and kind of started to turn fairly strong here just a couple of weeks ago. As you can see, we continue to sort of make a series of higher highs and higher lows. And this is really what starts to kind of shift the bearish trend that this stock has been in for quite some time into what it could be the start of a bullish trend here for Target. Now, it trades at 13 times forward earnings, which is very inexpensive for the retailing community, where the average is around closer to 18 times. And then if you're looking at kind of growth expectations, the only thing where it falls a little short is revenue growth. It has started to pick up a little bit in terms of revenue growth, but net margins, north of close to 4% is slightly higher than the industry average. So for those reasons, I think Target looks like an interesting opportunity for those who are looking to in this market environment where you're perhaps concerned about chasing stocks at all-time highs and hoping they go higher. Target provides an interesting alternative as an early potential trendsetter for this particular group. Looking at Microsoft, um, Microsoft has clearly, been an outperformer here for the last couple of months. This is really where we continue to see potential upside here, even though, in the short run, this is starting to look a little bit extended and exhausted here to the upside. You start to see some exhaustion here to the upside, but Microsoft trades around 31 times forward earnings, which is certainly not cheap. But if you look at growth expectations, we're talking about top and bottom line growth that's north of 13, 14%, that it far exceeds its industry. And more importantly, net margins north of 35%, where the industry average is close to around 9%. So for those reasons, Microsoft far superior growth and profitability commands a premium valuation, and the stock price also reflects kind of investor sentiment here for Microsoft. Another one I want to take a look at here is Schwab. We've looked at Schwab here last week. Sorry, this is the wrong symbol. Looked at this last week here. As you can see, this is the stock that recently broke out here above this $83 level here. It broke out. It's consolidated for some time, and we're looking for that continuation higher here. Schwab trades at around 20 times forward earnings, which if you think about the industry, which is closer around 23, that's a slight discount to the industry. It is expected to grow far faster than the industry, and it is far more profitable than the industry. So the fact that it trades at around a 10% discount to the industry is really where I think this has some potential further upside for Schwab. And then lastly, Micron. I really like Micron because for many investors who like the AI theme, NVIDIA is the most obvious buying opportunity in this particular space. However, NVIDIA is getting to the more expensive side. It's cheap a couple of months ago, but now it's trading at closer to 30. It's pushing, probably, let's see, it's pushing 33 and a half times forward earnings, which is starting to get a little bit expensive. It is expected to grow still pretty fast, 20, 30% top and bottom line growth, net margins north of 50%. Micron's not quite there yet, but EPS growth is of 100%, revenue growth 22%, net margins around 15%. So it's not as profitable, and memory chips, where it's relatively commoditized, generally trades at a lower multiple. But Micron has kind of retooled their business in the last couple of years to focus on these high bandwidth memory chips that specifically go into NVIDIA GPU chips that are used for kind of AI training and inference. That is kind of at the forefront of all of the AI infrastructure spend that is being put out there. And we see at the moment an incredible amount of strong demand for that kind of for those chips. And so, like I said, Micron is sort of a indirect way to invest in the AI infrastructure build out without trading some of the most obvious ones like NVIDIA as a way within the semiconductor space, trading at a far more reasonable valuation, which is why I quite like this particular stock as an AI play. On the flip side, looking at a couple of other ones that we've been taking a look at recently, International Paper. The paper industry continues to sort of underperform here. As you can see here by the chart, this continues to underperform by quite a wide margin, and we're looking for that continuation here. Our downside target for International Paper is $40. It's still trading at 21 times forward earnings, which is quite expensive for this type of company, which averages closer to around 13, 14 times forward earnings. It is expected to grow faster than the industry, but net margins are actually lower than the industry average, so it's not as profitable as the rest of the industry. So for those reasons, I believe there's further downside here for international paper. Another one I continue to take a bearish view on here is Apple. I've continued to, for the past few months, continue to say that, I feel Apple is overvalued. It continues to present kind of opportunities to take bearish positions here. It recently just generated a new bearish signal here for on options play. Apple trades at 25, 26 times forward earnings versus the 20 times forward earnings that the industry trades at. iPhone sales continue to disappoint, and we continue to see analyst expectations revise top and bottom line growth lower. The only thing that's kind of defending its premium valuation are its net margins, which currently sit around 24%. They've been able to maintain those margins despite kind of all of the pricing pressures that they've seen over the past few years. But this is really where, as iPhone sales continue to decline, as they kind of really botch their rollout here of AI, and they really lack kind of a direction for the future. This is really where I think, at the moment, Apple continues to see, I see further downside risks with Apple as opposed to, a positive outlook here. I don't think we're quite there yet. I hope that they get there soon. I hope that they figure out their AI solution soon. I hope that they are able to turn their Vision Pro business around. I think there's a lot of potential there. I don't think they've quite hit the mark here in terms of commercial product yet. I actually think Meta and Snapchat potentially are further ahead than them in the AR space with regards to commercial product. So for those reasons, I think at the moment there's still some downside risks with Apple, especially with the valuation that it's currently still trading at, which is a premium valuation that I think the company is, it's tough to justify. And then lastly, I'll take a look at T-Mobile, which is something that we've brought up here in the last few weeks. This stock has really continued to decline here. Had a nice run here yesterday, but as you can see, the overall trend remains negative here. T-Mobile trades at a very expensive 20 times forward earnings, which is more than double the industry average. It is expected to grow a little bit faster than the industry, but it's not any more profitable than the industry. So for the fact that it trades at a valuation that's double the industry, I think there is some downside risk there as well. So, that is a review of kind of where we currently stand here in the broader equity markets. We have despite all of the geopolitical tensions, the economic data that's coming out with regards to job numbers, with regards to inflation, manufacturing, they're all coming out relatively strong. And then recently we had the Treasury auctions that went fairly well. So a lot of the concerns that investors have had over the past, call it 5-6 weeks, trade deals, a lot of those concerns have eased a bit, and we find ourselves knocking on kind of all-time highs for the equity markets. And I feel that we're very much, it feels like we're very much going to hit those all-time highs and potentially go beyond those all-time highs. And if you look at technology shares today, XLK, we're about to open up just above, those all-time highs. So this is all going to potentially be beneficial here for equities. So with that covers what I wanted to share with you here today. I hope this is helpful in giving you a better understanding of my macro views as well as individual trade ideas for the week. With that, thank you so much. I hope you guys have a great trading day.